Welcome to The Deep Dive, the show that cuts through the noise and gets you straight to the most important nuggets of knowledge. Today, we're pulling back the curtain on something absolutely foundational to financial trust, yet often hidden in the background. How audits actually get off the ground and how their rigorous quality is maintained. It's a world of meticulous detail and critical safeguards, and frankly, it's more fascinating than you might imagine.
That's right. Our deep dive today is all about those foundational agreements and, the really rigorous quality checks that ensure an audit's integrity.
Hmm.
We're going to uncover the unseen structures that underpin financial transparency and build the trust we place in a company's reported numbers.
Okay, so our mission today is to really understand the intricate dance between companies and their auditors. We'll uncover some surprising facts about the careful steps taken before a single number is officially checked and how every decision and action gets meticulously documented. Let's explore. Okay, let's unpack this right from the very beginning. When an auditor is about to examine a company's books, it's far from a casual arrangement. It all starts with a very formal agreement. At the core of this relationship, you have the auditor, the company's management, and this key group often referred to as those charged with governance, or TCWG.
Right. And to make those distinctions crystal clear, management is, well, the individual or group responsible for the daily operations. They're handling the day-to-day running of the business. Those charged with governance, or TCWG, they're the ones who bear the ultimate responsibility for overseeing the entity's obligations and strategic direction. And this absolutely includes their financial reporting process. Think of them as the company's ultimate guardians or, the top-level oversight body. This broadly covers terms like a board of directors or an audit committee. And TCWG can actually take various forms. They might be the company directors or sometimes external parties like government agencies. Often it's a collective group like a full board or an audit committee. In smaller companies, it could even be a single owner manager. It's even possible, actually, for some personnel to wear both hats, having both management and governance responsibilities, though that definitely adds complexity.
So if TCWG are the ultimate guardians, here's where it gets really interesting. The audit committee. It sounds formal, and it definitely is, but its role is absolutely vital to financial trust.
It really is. The audit committee is typically a committee of the board of directors, usually made up of, say, 3 to 5 outside directors. And these outside directors are key because they are neither employees nor part of management and, critically, have no material financial interest in the company. This independence isn't just, a good idea. It's a critical component.
Why do companies have them? Is it just regulations?
Well, regulations play a big part. The SEC has strongly recommended them for a long time. And for public companies, the New York Stock Exchange actually requires all listed companies to have audit committees. But beyond the requirements, their most important purpose, I'd argue, is to truly strengthen the public's perception of the public accountant's independence. This really reinforces trust in the financial markets.
Okay, so they're independent overseers. What do they actually do?
Oh, these committees are incredibly busy. Their core function is to enhance internal control by creating a direct communication link between these independent outside directors and the independent auditor. They play a huge role. They select and appoint the auditor, they set the audit fee, and they're responsible for assuring the auditor's independence. That's huge. They also review the auditor's work, ensuring quality and proper scope. They make sure the auditor's recommendations get attention from the company, maintain open communication, help resolve any accounting disagreements. They even evaluate the company's internal control system with the auditor's help and make reports to the board and stockholders when needed. The core insight here, really, is that the audit committee fundamentally shifts the power dynamic. They act as the true client for the auditor, ensuring independence from management and prioritizing public trust.
And communication with this committee is paramount for the auditor, then.
Absolutely. It's a key element of the auditor's ongoing communication. The auditor needs appropriate access to the audit committee periodically. And crucially, they must meet with the audit committee without management present at least once each year. That private meeting ensures a really open dialogue. The auditor also needs to consider, is communication with just the audit committee enough? Or do they also need to talk with other members of the TCWG?
And then comes the big one that really changed the game. Sarbanes-Oxley, or SOX. How does that factor into this picture for public companies?
SOX. Yes, the Sarbanes-Oxley Act, specifically for issuers, that means public companies, really formalized and strengthened the audit committee's role. SOX mandates that the audit committee must approve the auditor's engagement. They must pre-approve all services the auditor performs. And it strictly prohibits certain non-audit services to protect independence. That was a major change. There's also a requirement for ongoing communication between the auditor and the audit committee. The fundamental shift here is that for issuers, auditors report to and are overseen by the audit committee, not by management. That fundamentally changes the power dynamic, creating a crucial check and balance.
Okay, so before an auditor even says yes to taking on a job, there's a whole checklist they go through. This isn't just about whether they're qualified, right? It sounds like it's about minimizing risk, too.
Exactly.
Hmm.
This is called client acceptance and continuance. It's the pre-acceptance phase.
Yeah.
Auditors assess several crucial factors. First, they look at their own firm's ability to handle the engagement. Can they actually meet the reporting deadlines? Do they have enough experienced personnel available? Think about the chaos of busy season. Second, they confirm their own independence. They need to ensure they are, and crucially can stay, independent throughout the entire engagement. That's absolutely non-negotiable.
Okay, ability and independence. What else?
Third, and this is huge, they assess the integrity of client management. Auditors really, really want to avoid associating with clients whose management might lack integrity. So they check the reputation of the client, its owners, key management, any related parties, those charged with governance. They look at the nature of their operations and their general attitude toward internal controls and maybe aggressive accounting. Imagine a company where management is constantly trying to bend the rules. An auditor needs to know that up front. And finally, for group audits involving multiple entities, they need to be sure they can actually get enough audit evidence for the consolidated financial statements, which often means coordinating with other auditors.
So before any actual auditing begins, what are the absolute must-haves, the non-negotiables, that a company has to have in place for an auditor to even consider the job?
Right, these are known as the preconditions for an audit. If these aren't present, the auditor generally should not accept the engagement unless they're legally obligated to. The first precondition is that the client must be using an applicable financial reporting framework like GAAP or IFRS that is acceptable. Basically, the accounting rules they're following have to make sense for their type of business and how their financial statements will be used.
Makes sense. What's the second one?
The second critical precondition involves management responsibilities. Management must explicitly agree to and understand their core responsibilities. First, they're responsible for preparing and fairly presenting the financial statements. That's fundamental. Second, they're responsible for designing, implementing, and maintaining internal controls to prevent material misstatements, whether from fraud or error. Good internal controls are crucial for a reliable audit. And third, they must provide the auditor with full access to all relevant information, any additional requested information, and unrestricted access to all necessary personnel within the entity. Without management's commitment to these three things, a proper audit is pretty much impossible.
And you mentioned there are even more preconditions for a very specific type of audit. ERSA plans, dealing with employee benefit plans. That sounds like a highly regulated area.
It is, very much so. For ERISA-planned financial statement audits, on top of the standard preconditions, management has specific additional responsibilities. They must agree to maintain a current plan instrument, that's the formal document outlining the plan. They also have to administer the plan correctly, ensuring all transactions conform to its provisions, and maintain sufficient records for each participant to determine their benefits. And what's also unique is if management elects something called an ERISA Section 1033C audit. This is where certain investment information is certified by a qualified institution, like a bank or trust company, which can streamline parts of the audit. If management chooses this path, they also take responsibility for determining if this type of audit is even permissible for them, that the investment info is prepared and certified by a qualified institution, that the certification meets Department of Labor rules, and that the certified info is properly measured, presented, and disclosed in the financial statements. It adds another layer of management responsibility.
Okay, what happens if the client maybe puts up barriers, like limiting what the auditor can see or do right from the start? Can an auditor still take that job?
Generally, no. If management, or those charged with governance, impose what's called a management-imposed scope limitation before the auditor even accepts the engagement, and if that limitation is so severe, it would force the auditor to issue a disclaimer of opinion on the financial statements as a whole, then the auditor should not accept that engagement. It's basically a non-starter because they can't do their job fully. There's a narrow exception, though. If an audit is legally required and a disclaimer of opinion is acceptable under those specific circumstances, like sometimes for certain employee benefit plans, then the auditor is permitted, but not required, to accept it.
Now, this sounds like a crucial update here. Something that maybe used to be called a limited scope audit for these ERISA plans is now quite different. What changed?
Yes, that's a significant shift under a standard called SAS 136. These audits are now formally called ERISA Section 103 A3C audits. And the key thing is they are no longer considered a scope limitation.
Ah, okay.
Instead of leading to a disclaimer, SAS 136 actually allows the auditor to issue a form of unmodified opinion. It's a new kind of two-pronged opinion unique to these ERISA plan audits. It
Right.
essentially says, first, the amounts and disclosures not covered by the certification are presented fairly, and second, that the investment information that is covered by the certification agrees to or is derived from the certified information provided by that qualified institution. So it's about clearly defining the audit scope based on that certification while still providing assurance on what was audited.
Okay, so once all these checks are done, all of the preconditions are met, scope seems okay, and the auditor has decided they can take the job. What actually seals the deal?
That's where the agreement on audit engagement terms comes in, and it's formalized by the absolutely vital engagement letter. This written agreement is crucial because it drastically reduces the risk of misunderstanding between the auditor and the client. It clarifies their respective responsibilities and expectations. It prevents inappropriate reliance. For example, it stops the client from mistakenly thinking the auditor will, I don't know, protect them from all business risks or perform functions that are actually management's job, like maintaining internal controls.
So what absolutely has to be in that letter?
Right, the engagement letter has required contents. It must include the objective and scope of the audit. It has to state the responsibilities of both the auditor and management, very clearly laid out. It needs a statement about the inherent limitations of an audit, basically saying, look, there's an unavoidable risk that some material misstatements might not be detected, even with a proper audit. It also identifies the applicable financial reporting framework, like GAAP or IFRS, and it refers to the expected form and content of the reports, with a little note that circumstances might cause the final report to differ. Then there are other contents that may be included, things like more detail on the scope, other forms of communication, planning arrangements, how fees will be handled, maybe mentioning if other auditors or specialists will be involved. For issuers, public companies under PCAOB standards, the engagement letter must be agreed with the audit committee and provided annually. This just reinforces the audit committee's central oversight role.
What about clients who've been audited before, or maybe a company changing auditors entirely? Does the process change much?
It does have some nuances. For recurring audits, that's an engagement for an existing client you've audited before. The auditor needs to assess if circumstances require revising the original engagement terms. Things like maybe management misunderstood the audit's objective, or there's been a change in senior management or ownership, a big shift in the business, or changes in laws or regulations. Those would warrant a revision. If the terms don't need revising, the auditor should still remind management of the terms, either with a new letter or just a documented reminder. Now, for initial audits, where the prior period's financials were either not audited or audited by a different firm, a predecessor auditor, communication with that predecessor auditor is mandatory.
Mandatory.
Yes. Yeah. It's a critical step, although you do need the client's permission first. If the client refuses permission, the new auditor really needs to consider why and if they can even accept the engagement. That's a red flag.
So what do you ask the old auditor?
Key inquiries made to a predecessor include asking about any identified or suspected fraud or noncompliance with laws. You ask about the integrity of management that comes up again, any past disagreements over accounting principles or auditing procedures. What's the predecessor's understanding of why the auditor change happened? Were there any past communications regarding internal control weaknesses or any understandings about related party transactions? The predecessor has a responsibility to respond promptly and thoroughly and honestly and to disclose if there are any limitations on their response.
Okay, shifting gears slightly. Sometimes a client might want to change the type of engagement midway, say, from a full audit down to maybe a review or a compilation. Is that even allowed? Does it raise red flags?
It is possible, but the accountant has to be very, very careful and evaluate the situation thoroughly. Before agreeing to a change in engagement, the accountant needs to consider the reason for the request, especially if there's any hint of a scope limitation involved. They also look at the effort required for the change and any additional cost. There are definitely acceptable reasons for a change. Maybe there was a genuine shift in client requirements or simply a misunderstanding about the nature of the service originally intended. That can happen. but there are also unacceptable reasons. For instance, if the change seems to be requested because the original audit would have uncovered errors or fraud.
Ah, trying to hide something.
Exactly. Or if the client's trying to create misleading financial statements. In those cases, the accountant absolutely cannot agree to the change. Their integrity comes first. If a change is justified, the accountant follows the standards for the new, lower-level engagement type. And importantly, the new report should not refer back to the original engagement or any procedures that were performed under it.
Okay, so let's assume the engagement is accepted, the terms are agreed. But how does an audit firm make sure every single engagement they take on meets consistently high standards? This is where engagement quality comes in, right? Building that culture of excellence.
This is such a critical point. It really differentiates professional audit firms. Any firm that provides audit, attestation, or accounting and review services must adopt a system of quality control. This system is basically a set of policies and procedures designed to ensure the firm consistently complies with professional standards and legal requirements. And, critically, that any reports they issue are appropriate in the circumstances. It's all about consistency and reliability across all their work, not just having one good audit now and then.
And you mentioned a way to remember the elements of this system, HELPME.
That's right. It's a great mnemonic. The 6 interrelated elements of quality control can be remembered as HAIL-LP-ME. Human resources, engagement, client acceptance, and continuance, which we just covered in detail. Leadership responsibilities, performance of the engagement, monitoring, and ethical requirements. These aren't just, boxes to check. They're the fundamental pillars of a quality audit practice.
Okay, can you break those down a bit? What does human resources mean in this context?
Sure. Human resources policies are about ensuring the firm has competent personnel, that they're assigned appropriately to engagements based on skill and experience, that they're engaged in ongoing professional development, and that they're rewarded for quality work. Think hiring smart, good training, performance reviews. Leadership responsibilities means the firm's leaders, the partners, usually set the tone at the top. They have to emphasize quality over just making money, link performance evils to quality work, devote enough resources to quality control, and make sure experienced people are leading the quality efforts.
Got it. And performance.
Performance of the engagement focuses on achieving consistently high performance across all audits. This involves using standardized manuals, software, documentation templates. It ensures proper supervision and review of work done by staff. It also covers how to handle client confidentiality and how to resolve differences of opinion within the audit team if they arise. Monitoring policies mean the firm continuously evaluates its own quality control system to make sure it's relevant, adequate, and actually working effectively. Are people complying with it? This often involves reviews of completed engagements, internal inspections, things like that. And under Sarbanes-Oxley, remember, there's that mandatory wrap-up or pre-issuance review by a second partner for every public company audit report. That's a key monitoring control. And finally, ethical requirements are all about ensuring independence, both in fact and in appearance, as well as integrity and objectivity. This means strict rules about conflicts of interest, communicating those rules, getting annual written confirmations of independence from all personnel, and rotating staff on engagement sometimes.
So, how do these layers of quality review actually happen on the ground within a specific audit team? How is work checked?
Well, every single piece of audit work must be reviewed. That's a basic principle. The review is to ensure the work was adequately performed, that it was properly documented, and that it genuinely supports the conclusions reached in the final audit report. Typically, individuals who are senior to those who perform the work conduct the review. So a senior reviews a junior's work, a manager reviews the seniors, and so on. The review considers things like, was the work done according to professional standards? Were significant findings properly addressed? Was enough appropriate evidence gathered? The engagement partner, who has the ultimate responsibility for the audit, has specific duties for the timely review of critical judgment areas and significant risks during the audit, not just at the end. And this is vital for accountability. The audit documentation, the work papers, must clearly show who performed the work and when they did it, and also who reviewed that work and when and to what extent the review was done. This creates a clear audit trail and ensures accountability.
Let's zoom in on a very specific kind of quality check you mentioned, the Engagement Quality Control Review, or EQCR. You said this differs slightly depending on whether you're auditing a private company versus a public one.
That's right. There are key distinctions based on the standards being followed. For non-issuer engagements, which follow US GAAP, generally accepted auditing standards, the main goal of the EQCR is to ensure the audit complied with professional standards and that the report being issued is appropriate. While the engagement partner is ultimately responsible, they rely on the firm's overall quality control system. The EQCR itself provides an objective evaluation of the significant judgments the team made and the conclusions they reached. This review is performed only if the firm's policy requires it for that type of engagement, and it must be completed before the audit report is released. The reviewer has to be independent and competent, could be another partner, someone else in the firm, or even a suitably qualified external person. A critical point. If the reviewer finds issues after the report date that require more work or evidence, the date of the auditor's report must change to reflect when that additional work was completed.
Okay, so that's for non-issuers. How about for issuers, the public companies under PCAOB standards?
Right, for issuer engagements, following PCAOB standards, engagement quality reviews are required for all audits of public companies and also for reviews of their interim financial statements. It's not optional. Here, the reviewer must be a partner who is not otherwise associated with the engagement ensuring objectivity. They must also be competent, independent, objective, and act with integrity. The engagement quality review process for issuers is incredibly thorough. It involves evaluating planning judgments, risk assessments, including fraud risks, materiality decisions, the firm's independence check, reviewing key documents like the engagement completion document, the financial statements and draft report, related SEC filings, consultations held, and communications with the audit committee. It's a deep dive.
And this leads to a really critical point unique to public companies, this concurring approval of issuance. What exactly is that?
Precisely. This is a major safeguard under PCAOB standards. The audit firm cannot give the client permission to use the engagement report, basically. Yeah. They can't issue the report until the engagement quality reviewer provides concurring approval of issuance.
Wow, so the reviewer has veto power.
In essence, yes. This approval is only granted if there are no significant engagement deficiencies. And a significant engagement deficiency means something fundamental went wrong, like the engagement team didn't get enough appropriate evidence to support their opinion, or they reached an inappropriate overall conclusion, or the report itself wasn't appropriate for the circumstances, or critically, the firm itself was found not to be independent. If any of those exist, the reviewer cannot give concurring approval, and the report cannot be issued until the deficiency is resolved. It's a powerful final check, a vital safeguard for investors relying on those reports.
Okay, so we have internal reviews, partner reviews, engagement quality reviews. Is there also an external check on the audit firm's quality itself, like an audit of the auditors?
Exactly, there is. That's called a peer review. This is where one CPA firm reviews another CPA firm's compliance with its overall quality control system. It's actually a mandatory requirement for members of the AICPA, the main professional body. Firms must have a peer review every 3 years to maintain their membership. After the review, a report is issued with conclusions and recommendations. And if a firm fails to correct identified deficiencies, they can face sanctions from the professional bodies. It really keeps everyone accountable to maintain high standards across the profession. So, just to clarify the relationship here, GAS, the Generally Accepted Auditing Standards, apply to each individual audit engagement. Quality control standards, on the other hand, apply to the firm's practice as a whole. Now, obviously, an effective quality control system helps a firm comply with GA on individual audits. But technically, a deficiency in the firm's overall QC system doesn't automatically mean GA wasn't met on any one specific audit, though it might raise questions. They really work in tandem to ensure quality.
Okay, now imagine all this meticulous work, all these careful decisions, all these layers of checks and balances we've just talked about. How is it all preserved? How is it proven? That's where audit documentation comes in, right? Making sure everything is recorded.
Yes, absolutely. Audit documentation, you might also hear it called working papers or work papers, is the principal record of everything the auditor did. It includes the audit procedures performed, the evidence they obtained, and the conclusions they reached. It serves two main purposes. One, it provides the verifiable evidence for the auditor's report and the conclusions stated in it. Two, it proves that the audit was actually conducted in accordance with generally accepted auditing standards and any applicable legal or regulatory requirements. It's essentially the verifiable history of the audit.
Yeah.
It makes the whole process transparent and defensible.
What exactly makes for good audit documentation? I imagine it needs to be pretty detailed for someone else to pick it up and understand everything.
Exactly. The overall requirements for audit documentation are quite stringent for that very reason. It needs to be detailed enough so that an experienced auditor, someone who knows auditing but has no prior connection to this specific audit, can clearly understand. What was the nature, extent, and timing of the procedures performed? What were the results of those procedures, and what evidence was obtained? Were there any significant findings or issues that came up? And what conclusions were reached, including the significant professional judgments made to get there? And crucially, it absolutely must show who performed the work and when they did it, and who reviewed that work, and when and to what extent that review happened. That accountability trail is vital.
That brings up a really important point we discussed earlier, documenting professional skepticism. How does that actually show up in the documentation? It's not just about facts, it's about the auditor's mindset, right?
Yeah, that's a great question, and it can be subtle. While documentation primarily focuses on facts, procedures, and evidence, it should also provide evidence that professional skepticism was maintained. For example, let's say the auditor found some evidence that contradicted what management was saying, but also found other evidence that supported it. Good documentation wouldn't just list the contradictory evidence. It would show how the auditor evaluated both pieces of evidence, what questions they asked, maybe notes from challenging discussions with management, and the professional judgments made in concluding how that inconsistency impacted the audit. It's not just about what you found, but documenting how you critically thought about it and resolved inconsistencies. That demonstrates skepticism in action.
Okay, so once the audit report is issued, what happens to all those papers and electronic files? Are they just archived somewhere indefinitely?
Not quite indefinitely. They're subject to very strict retention and completion rules. First, there's the report release date. That's the official date the auditor grants the client permission to actually use the audit report. This date must be documented. Now, for document retention, the rules differ slightly. Under SaaS rules, for non-issuers, private companies, audit documentation must be retained for at least 5 years from that report release date. However, for issuers, public companies, the PCAB rules, influenced heavily by Sarbanes-Oxley, require auditors to keep audit documentation for a longer period, 7 years from the report release date. That longer period reflects the greater public interest and regulatory scrutiny for public companies.
Okay, 5 years for non-issuers, 7 for issuers. And is there a deadline to finalize the file after the report is out?
Yes, that's the documentation completion date. Auditors have a specific window of time after the report release date to assemble the final audit file, making sure everything is complete and organized. For non-issuers under SaaS rules, that window is typically 60 days. For issuers under PCAB rules, it's a tighter deadline, 45 days. And for issuers, there's also a requirement to prepare an engagement completion document that summarizes all significant findings and issues identified during the audit. And finally, safekeeping is paramount. The firm must take reasonable precautions to maintain the integrity and security of the audit documentation, preventing unauthorized changes. After all, this documentation is the primary proof that a professional audit was performed. The Sarbanes-Oxley Act even imposes some pretty tough penalties for failing to retain records properly or for destroying them prematurely, highlighting just how serious these requirements are.
So what does audit documentation actually look like? Is it all just stacks of paper and binders, or is it more modern now?
It can be paper, but increasingly it's electronic, or a mix of both. The key thing is, oral explanations alone are absolutely insufficient as documentation. You need the record. The specific quantity, type, and content of the documentation will vary based on the auditor's professional judgment. They'll consider factors like the size and complexity of the company being audited, the nature of the specific auditing procedures being performed, the assessed risk of material misstatement, the significance of the evidence obtained, any exceptions found, how much judgment was required, and the overall methodology used. Generally, though, audit files are often organized into 2 main categories. There's the permanent file, sometimes called the continuous file. This holds documents that have continuing interest from year to year. Think things like long-term contracts, pension plan details, company bylaws, articles of incorporation, minutes from important board meetings, stuff you refer back to over multiple audits. Then there's the current file. This contains all the documentation specific to the year currently under audit. This is where you'll find the audit plan, copies of the financial statements and the auditor's report, the working trial balance, any adjusting journal entries proposed, confirmation letters received, representation letters from management, detailed analyses of accounts, summaries of findings, and crucially, the detailed records of all the tests of controls and substantive tests performed.
What are some of those aha moments or really crucial decisions that absolutely need to be captured clearly in the documentation?
Right, these are often referred to as significant audit findings. Auditors need to make sure these are well documented. This includes important matters related to accounting principles, especially if they involve complex or unusual transactions, significant accounting estimates, or major uncertainties. It also covers anything that gives rise to significant risks identified by the auditor. Any findings that might point to possible material misstatements in the financial statements, situations where the auditor needed to significantly revise their original risk assessment or planned procedures based on new evidence, any significant difficulties encountered in applying necessary audit procedures, and of course, anything that might lead to a modification of the auditor's opinion in the final report, like a qualified opinion or worse. Summarizing these significant findings clearly helps facilitate effective and efficient reviews of the audit work.
And finally, there's a quirky but apparently essential detail of the audit world. Tick marks. What on earth are those, and why are they important?
Ah, tick marks. Yes, they might look quirky, but they're a very efficient tool. Tick marks are basically small symbols like check marks, circles, letters, numbers, triangles, you name it, that auditors use directly on their working papers, maybe next to a number or an item. They're used to concisely indicate that a specific piece of work has been performed. For example, a little V might mean vouched a supporting invoice, or air might mean footed, meaning the column was added up. The absolutely crucial part, though, is that the audit documentation must include clear explanations of any and all tick marks used. Usually there's a legend somewhere on the work paper. Without that key or legend, the symbols are meaningless. But with it, they provide a quick, efficient, standardized way to show precisely what procedures were done and how evidence was traced and verified. It's a small detail, but it's essential for clarity and for anyone reviewing the audit trail later.
Wow, what a deep dive. Today, we've really journeyed through the incredibly structured world of audit engagements. From that very first handshake, or rather the formal agreement, and all the conditions that come before it, through the layers of quality control that keep firms accountable, and right down to the final, documented tick mark proving the work was done. We've seen how everything from who oversees the company, like that crucial audit committee, to how the audit firm ensures its own quality plays a vital role in building the trust we place in financial reporting.
Indeed. Understanding these sometimes intricate processes, especially the critical role of the audit committee, the huge impact of SOX on public company audits, and just the sheer discipline behind a firm's system of quality control and the detailed documentation required. It really reveals just how many layers of assurance are built into our financial system. It's truly not just about crunching numbers, is it? It's about establishing a robust foundation of trust and accountability that, frankly, underpins our whole economy.
So, thinking about all this, what does it really mean for you, the listener?
Well, I think it raises an important question, maybe something to ponder. In a world absolutely inundated with information, how much attention do we truly pay to the process behind the information we consume, not just the information itself? Does knowing the rigor, the structure, the oversight, the quality checks that go into an audited financial statement, does that change how you perceive a company's reliability? Does it change how you view the integrity of the figures they report? It really makes you think about where trust comes from and how it's built and maintained.
That is a great question to ponder. Thank you so much for joining us on this deep dive into the fascinating and crucial world of audit engagements and quality. Until next time, keep learning, keep questioning, and stay well informed.